green credits, filling the transition funding gap. Ladies and gentlemen, private credit is emerging as a vital mechanism for addressing the significant transition funding gap in India, particularly in the context of countries' ambitious climate goals. Now, as banks become increasingly risk-averse, private credit funds are stepping in to fill this void, offering tailored financial solutions that cater to the unique needs of businesses engaged in sustainable initiatives. This is going to be one interesting conversation, and to take this forward, we are being joined by Director and Head Strategy, Alternative Credit, Sundaram Alternates, Karthik B. Athreya. We're very glad to have amongst us Shaurya Arora, Chief Investment Officer and Partner, UTI Alternatives. Laurent Gonnet, Lead Financial Sector Specialist at the World Bank. Nilesh Shrivastava, Partner, Strategic Opportunities Fund, National Investment and Infrastructure Fund. Thank you for joining us. And the panel to be moderated by partner at Trilegal, Upasana Rao. Over to you, Upasana.
Hello. So we'll get right into it. So you must have heard in the last 2 days a lot about the amount of capital that is needed for our very ambitious net zero goals in the country and our intermittent goals as of 2030. Obviously, public capital will not be enough, and there is a high need to channelize more private investment. The discussion we are going to have today is focused around how debt capital can play a larger role in accelerating the transition in India. So maybe I can ask Karthik for your opening comments. Karthik from Sundaram Alternates, how big is the role, do you think, for private credit and in funding climate transition? And what is your view as for climate transition? Is it a key investment theme for you? And do you think of it as a commercial opportunity?
Thank you, Upasana, and thanks to IVCA for having us here. I can see that the concept of debt, holds no great excitement for this group. I think people are more or less winding down. But the interesting thing to note is that debt capital accounts for 70% of climate financing, particularly in India. So I think it's a super relevant concept, and I'm thankful to be on the stage with panelists of this stature. Over the last 2 days, I've heard so many numbers, and honestly, this is my first experience at a climate conference. And a lot of the terminologies and the acronyms just completely went over my head. So I've been learning as well. But what I noticed were massively different sets of numbers, as was discussed in the panel before the last one, on what exactly is the amount of money that is required to go to net zero, achieve visions, and so on and so forth. And I heard varying estimates from yesterday morning till a few minutes ago of starting 100 billion going to 8 trillion. So that's a pretty wide gap. But bottom line is, we're debt guys. So we'll always like to start with the lowest and the most skeptical number. So starting from 100 billion, the actual expenditure from the reports that I could see in India has been 22 billion, okay? And within that 22 billion, 5 billion roughly is coming from equity, which we've heard in numerous panels over the last 2 days, and 17 billion is coming from credit players. That includes multilats, local lenders, private credit guys like us, and so on. So if you ask me, the gap is that, and the role of private credit is exactly that, to bridge that gap and have innovative ways to actually finance a meaningful lowercase number of getting to anywhere close to that 100 billion a year. And also, as Mr. Jain Sinha said yesterday, The idea is, one is to look at 2070, 2050, 2030. So I think sitting here today at 2024, 2030 is a more meaningful and visible number. For us as credit guys, we always like to look at a definite, definable future, rather than, bet on J curves and so on and so forth. So the numbers that I'm quoting are targets to get to 2030 sort of norms. Within that, I think there are a variety of opportunities for credit guys, and one is the size of the opportunity, which I just went through. The other is also that, I also heard from yesterday, varying returns, as is the theme of this conference. So the private equity guys, mostly venture, seem to be making returns in excess of 25-30% from what I heard, right? And on the other end of the spectrum, I've had conversations with a few startups and pre-Series A companies in this conference, which were expecting credit at 10%, right? So there again, the gap seems massively wide. So I think the answer lies somewhere in between, and I'm pretty sure that as we go around the panel, you will see return expectations are anywhere between 15 to 20% as far as private credit is concerned, and we are meaningful bridges between a high-cost equity, which is dilutive, and a low-cost debt, which may be harder to access. So that in terms of themes, there are roughly two themes, as I understood, over the last 24 hours. One is tech and its influence on climate change, and the other is tech absorption, which is really what I'd like to think credit guys fund, because tech by itself is an equity strategy. And effectively, those often tend to be early stage, which is why we saw a plethora of early stage equity financiers. We come in more in terms of growth capital, in terms of capex, working capital, and including hybrid things like bridging equity and debt, especially on projects and growth. So I think those are the themes that Sundaram largely follows in our own green sort of embracing, which we've done over the past 2 years, where we have two broad themes. One is on the residential real estate side, which is 80% of the market, where we've, over the last 2 years, consistently financed companies in terms of embracing climate. So we measure emissions on the way in, measure emissions on the way out. We see an impact analysis. We also look at stuff to do with design specs, where we have companies, our developers put in things like EV charging stations, recycling, and so on, and make that part of performance governance that we have in our contracts. So I can say that in the very short last 12 months, where we just released our impact report, we've had roughly 6 million square feet of green spaces that we've helped create. We've saved close to, or rather embodied carbon savings of close to 10,000 tons. And we've also had an impact, and this is an impact coming out of perhaps 50 projects. Today, as we speak, we are financing close to 250 projects. So we hope that on a compounding basis, the numbers that I'm showing are going to non-linearly expand. So I think this, in our world, is perhaps a view of where private credit's role is as far as India is concerned.
Thank you, Karthik. So if I can turn to Nilesh. So Nilesh, NIIF has successfully pooled in global capital and scaled private sector investment in green themes already across renewable energy, mobility, waste management, etc. And clearly, large pools of capital are willing to be deployed if the right kind of structures are put in place, right? So from your point of view, given that when we talk of renewable energy and infrastructure, we have already seen that commercial banks and even infrastructure funds over the last decade have played a major role in scaling it up. Do you think this will continue as a concept, as well as what is your outlook for alternative lenders in playing a larger role and participating to fill in the funding gaps that Karthik talked about?
No, thanks a lot for the opportunity. I think just a few things from our end, at least how we've seen green transition sort of cross-cuts across investments for us. So we have sort of three roles that we have looked at as an investor. One is as an operator. We actually run assets and build them. We are a lender. We own 2 NBFCs in the infra-lending space, so have a large exposure to green transition. And then, of course, as an equity investor, right, in multiple entities. I think one consistent theme we have seen is that underlying bankability remains very critical, and scale. So irrespective of the theme, yes, there is a preference for, if green transition comes up, or in terms of the underlying, let's say, reporting, disclosure requirements or other, there's obviously a preference, but that cannot override the underlying bankability and the ability to eventually make commercial returns, right? I think that is consistent, we have seen with most investors that we talk to. That's number one. Second, I think on the credit side, our experience started with our NBFCs, which are now sort of managing about a little over $4 billion in AUM. Roughly 50% of that is in the green space, right? So we have, I would say, a reasonable sense of where the market is going in terms of, I would say, a large part of the bankable element of green is still lying on the renewable energy side, right? There are a few smaller segments. The other elements, I think, where the underlying either the contracts or business sort of concepts have still to scale up a little bit in terms of overall, as I call it, within the bankability sort of spectrum. And as that does, more and more people will start approaching them. So our focus on the senior credit side, which is what NBFCs typically do, has been actually very positive. What that has delivered for us is really not just apart from the numbers and so on, is a comfort that there is now a very clear mechanism of, underlying security and typically things like credit people look at, right? Security, recoverability, people are willing to, the intent is there to repay and so on. I think that has been, at least reasonably well proven for us. And that's why that gave us comfort to move into what we call the broader performing credit space, right? What we also saw is that within the, as he was mentioning, that there is a lot of talk of equity, right? Equity, availability. Now, whether it comes to a particular entity or not, that's a different question. But there are providers of equity available. I would say in India, there are reasonable providers of senior credit available, whether it's through the banking system, NBFC system. I think where there is a very significant gap is performing credit, right? I mean, there are players like Sundaram and UTI and many others. But our sense is that for a market as large as India, the largest funds would probably be in the, say, $500 million range maximum. Also, they would look at multiple opportunities. Green would be one of them. The way we looked at it is that we thought this was a opportunity on its own. And we are now in the process of raising a fund just for the green transition space, which will be hopefully a large one. And we see how that goes. But I think the opportunity needs separate focus. And going just beyond renewables, because the whole green transition space is not about renewables. There are multiple sectors, and I think the improving credit profile in many of them, whether it's mobility, transmission related, and the underlying sectors that support this. So, for example, solar cells, batteries, all of this is feeding into the ecosystem. So, seeing the ecosystem as a whole and not in bits and pieces, and see if we can provide credit solutions. The second reason why this is needed is many of these industries are evolving, right? So they don't have, the classic, underlying security and some of those structures. You need flexible capital. So essentially, we see ourselves as last mile supporters, right? I mean, you have everything tied up, but you have that small piece missing. How do you fill that gap? How do you close it, right? That's what we see our role. We don't see ourselves as, the 70-30 split, which is typically said of debt and equity. We probably see ourselves filling maybe a 5 or 10% gap, right? But that 5 or 10% gap really helps the project go to the last mile, right? Closure. So that's really what we see, and I think that process is now picking up pace. There are others, I'm sure, who are looking at it, but we see ourselves, probably trying to help that pace a little bit more further. Thanks.
Thanks, Nilesh. Laurent. So green transition will continue to need public-private participation, partnerships, and participation from development banks, agencies, multilateral agencies, right? And from a World Bank perspective, you have been working with the Indian government and agencies on many energy transition programs. You've been providing direct finance as well as other ways, mobilizing private investments. So your views on how this has helped in scaling private investment, and what do you think are the other ways in which private investments can be channelized further? What are the de-risking strategies that you think that we are missing in the market?
Thank you. Okay, so we have some work to do more, a little bit more in India particularly. World Bank, usually what we do is typically we lend to a government, and the government on lend to traditionally public bank to finally reach the beneficiary. It has zero impact in terms of capital mobilization because we are using our own resources and it's one-on-one. So the end beneficiary, which could be an MSME, which could be a farmer, at the end of the day, he or she gets the money from the World Bank. So this is the traditional approach. In India, because we are so small compared to India, and because the government rightfully asks us to do differently, we are currently scratching our heads to come with a new approach to mobilize this capital. And the idea is that, and this is very, I mean, this is current, including this morning. The reason why I was not there is because we had a discussion with the government, the Ministry of Finance, and they were precisely asking to innovate in terms of capital mobilization. So $1 from the World Bank could lead to minimum $5 to $10 from the private banks or the public banks, but the leverage should be there. So all our operations now should have a leverage. How do we do that? So we are still on the brainstorming mode. We have a couple of ideas, and I will unveil two of them. One is to work on the strengths of the banking sector in India, which is co-lending. We see a lot of co-lending happening on the market between banks, public banks, private banks, between banks and NBFCs, and this is a relatively new model for people like me working at the World Bank, because there is no other similar model in the world. So co-lending is very interesting, and therefore we started a discussion with SBI, but we could have started with another bank. I think we are also talking to NABARD. So one public financial institution, whereby we lend to them, like we do traditionally, but instead of doing one-on-one, we say, you, SBI, you will have to co-lend with a private bank or with an NBFC. And therefore, we are going to have a bigger leverage. The second idea we are working on is on the credit enhancement. And this is more for long-term access to finance, because we are working with issuers of bonds. We noticed that in India, there's a lot of issuers on the market, so corporate issuers, and some of them are luckily rated AA, and some, by definition, are not AA, and they are below. But the thing is that who buys those AA bonds and above? These are the traditional pension funds, insurance companies. So there is a gap. When you issue bonds below, you get nothing. This is a well-known issue. There are many reasons to that, but in order to break that logic, credit enhancement could be a solution. So we have been working over the last couple of months with the central bank to amend the regulation on the credit enhancement. So banks like NABFID or I think you yourself, you can very soon issue this credit enhancement. You can do that, and you can allow issuers to leverage more money from the traditional investors, which are the insurance company and the pension funds. Now, if that money could go to the green transition, that's perfect. And this is also where the regulators should be a little bit smarter and put some additional regulation on for example, forcing, or let's put it differently, making mandatory for insurance company and pension funds to invest in green bonds issued by corporate. So we have other ideas like this, but we are on this brainstorming mode, and we are hopefully coming to soon with an operation like this.
Shaurya, so there's a perception that climate sectors could have low liquidity or slow returns, right? But as Nilesh also pointed out, the set of borrowers is pretty diverse. So there are borrowers where there would be new technology and there could be technology risk and probably no asset or balance sheet, but there are also borrowers who are looking to decarbonize and they are established businesses with strong balance sheets, right? So diverse forms of financing may be needed. So in that context, your comments on whether bespoke private credit products, how could they fill in this gap?
Sure, Upasana. So I think the word you use, bespoke, I think is a very interesting word, because we've been doing private credit since 2017 at UTI. We would have done about 45 companies across sectors: old economy, renewables, services, manufacturing. And I can say I think all 45 of them have actually been bespoke, because private credit is an expensive form of debt capital. So therefore, when issuers are coming to us to raise private credit, they're looking for something that they're not able to get off the shelf from somewhere else. So I think I can say that we do specialize in bespoke capital solutions in the credit size, and I'm sure Karthik would agree with me, and so would everybody else. But one of the things we realized, so when we started off private credit in 2017, in 2019 we decided that we need to start focusing on responsible investing. This was in our second series of the fund when we had a sense for where the market was. And we thought, how do we approach it? How do we become a more responsible investor or a sustainable in investing? So we had a lot of fears, right? We were worried that, will I have to compromise on returns? I'm an expensive lender. Will I have enough time? Because issuers would want to exit me sooner rather than later. Would we have that much of leeway over the companies? Because we typically don't take board representation, which equity investors would. So they would have the time, the patience, and promoters would listen to them because you're on the board. The other thing is maybe unique to us also is that we're very mid-market focused. So we're dealing with companies that are much smaller, right? And those companies have a lot on their plate. Would social, environment, those sort of factors, saddle them with things that they don't want. But I think we're very pleasantly surprised that we did not have to become very bespoke when it came to our, responsible investing goals. So we set up a policy where we said that we'll measure, and this is not just climate, our policy is ESG, so environment, social, and governance. So it does have the environment factor, but it's not exclusively towards climate change. And when we started engaging with our potential portfolio companies, we were pleasantly surprised that they wanted to embrace it more than we wanted or expected, because inherently, the promoters that we dealt with were, okay, I didn't think about this, but why not? If I can do something good along with my business, then why shouldn't I? So we were actually very surprised that the acceptance was there already. So we didn't have to be too bespoke on the, the responsible aspect of it. In fact, we quickly revised the policy. We said, we can do more. So let's add in more elements that we incorporate into our, ESG measurement and enhancements. So, so our experience has been that, there is a role for private credit to provide not just capital, but tag along, goals or measurable impact action items that I think we can, as an industry, pretty easily do when it comes to our portfolio level. I think the challenge has been, different LPs. So our investors have different asks. They have different requirements. So in fact, there's something that's, pleasantly surprised us in the recent past has been, I think, a lot of the concept of blended finance is now coming into, I think, in the credit space, where, I can run my strategy the way I've been running it, but I can also invite some, targeted capital into my LP base, where let us say the target, like Laurent mentioned, is that, for every rupee that I get, maybe 4 rupees, 5 rupees, 3 rupees, I invest into those targeted objectives within my broader portfolio. I think that sort of innovation and that sort of, bespoke fundraising might actually give the impetus to at least the credit side of the business to do a lot more. But I think on a portfolio side, we've experienced that we can do a lot already.
Yeah, on a lighter
Karthik,
vein,
before you-
I must consult with Shaurya because our experience has been quite the opposite. And we've actually really had to force a lot of climate change into our investee companies. Our promoters say, "मैं तिरुपति जाके आया, तो मेरा सारा पाप ठीक है अभी." So that is their contribution to climate. So it's been much, much harder for us, and we've had to innovate. For example, in the real estate side, when we finance resi on green, many of the clauses that we've actually put in, have actually resulted in price increases for them onward to the final consumer. And we've bridged equity portions into energy product, renewable energy projects. We've actually looked at, an asset acquisition, out of distress, which is into the, decarbonization theme. So, we've had to look at opportunities, innovate on deal structures to be able to make the returns that we have. And I can say that, we've done over $140 million of, impactful stuff so far, to the point where we think that there is enough of a theme. The good news is that there's enough of a theme for us to launch our own climate fund, which we are in the process of doing at this point in time, both as an NIIF as well as in the Gift City. So I just thought I'd tell you I should consult him.
I'm happy to share my secret sauce with you, Karthik. We'll exchange notes.
So, Karthik, actually, I wanted you also to speak about how you're seeing the domestic investors participate in this. So we know that, global investors are bringing in these mandates of sustainability and all. What is your view on how global investors
Short
are
answer
looking?
is domestic investors don't care. So I don't think this is a theme for domestic investors at all. So I think while we raise more than 95% of our capital domestically, so I can confidently say that there are very few who are looking even in this direction. So most of them are focused on risk reward. But I'm hoping that will change, beginning with some family offices, who have large philanthropy endowment structures embedded in them. So I think they have increasingly started to look at stuff like this. But I don't think it's part of the mainstream as it is in the Western world.
That segues well to the next question that Nilesh, you could help answer. So, one of the main things about having a credible climate finance ecosystem is having a shared understanding of what is green, right? And that speaks to the point of the green taxonomy. So as NIIF, you had a working committee, you engaged with stakeholders, government agencies to bring about some understanding of what a green taxonomy should look like, right? And at the same time, under Indian regulations, we know that our Indian regulators have, in the past few years, they have changed the regulations where they've detailed out a little more of what they see as green activities, right? At the same time, there's also a difference between what is green finance and what is transition finance. And I believe, Laurent, I'll ask you for your views as well. But global taxonomies are actually making that distinction. But how are you seeing this green taxonomy play out, and why is it not already here?
Okay, so I think the simplest answer to that, it's still confusing. Okay, in fact, I think Akhilesh is here. He was involved in NIIF earlier on, sort of trying to simplify this whole taxonomy thing. But I think at the very fundamental level, what we are seeing, and when we are going out and meeting clients, but more than anything, there are some sectors or segments of the broader green transition which are obvious, right? Where maybe parts of renewables, mobility, and so on. But there is a very wide spectrum where it's very hazy. Right? And I think that's where having the right taxonomy and making sure that it is clear and understandable actually gets more investment in. Our experience has been that there are investors, both among the development institutions as well as sort of commercial investors, who would want to, and I'm talking about globally here, I would say less. I would agree that in the domestic it's a slightly less, who are keen and who are actually keen to do slightly differentiated stuff. The problem is that they still don't have a full understanding of what can constitute green apart from the top 2-3 segments, right? So I think the taxonomy actually expands the space rather than makes it complicated. So I think that becomes almost like a basic 101, right? If we get that right, and I think the good thing is, apart from the few things that NIIF has been involved, I think broadly, this was mentioned in the budget. We know RBI is now looking at it, and actually having the financial sector understand this on a common basis is actually phenomenal, because the lenders, public and private lenders, are actually a big gateway into green finance, right? If they can get it right, a lot of things can get it right. So I think a lot of the key players are now sensitized to this. Hopefully there'll be much more movement. But I think the key for us is really expanding the definition will get more capital in, because that can, let's say even many manufacturing related sectors have a lot of many elements that are relevant, but just don't get the requisite attention, requisite finance, right? So getting that right will become critical for it. we think probably it's maybe 12 months away or something, where many of these things start to clarify more. Now, globally, of course, a lot of things are happening, and the unfortunate part is that there are many standards, right? Whether you call it SFDR in Europe, or there are many other standards. Hopefully they converge, and there'll be better ease of understanding here. But I think it's starting to improve. That's the positive side.
But just adding on to that, so most of the Indian regulations where they brought in these changes, they are more, they are helping have a better understanding of this in the context of public markets, right? But do you think a national green taxonomy will actually help bring clarity across asset classes? Because we are talking about private credit as well, and are private credit funds seeking that clarity as well?
Partly because it's also dependent on who the investor is. You see, the taxonomy is actually just as relevant. I mean, I would say, of course, relevant for the investee, but it's far more relevant for the investor, right, and eventual investors. And some of those investors are sitting outside, and they follow different standards, right? I mean, that unfortunately will not change. So yes, it helps to have a common understanding, but there will always be small differences which we as sort of investor will have to cater to.
Laurent, if you can add to this point as well. So as I said, in various global taxonomies, it's not just about classifying activities as green or transition related, but they've gone to the point of actually including very technical parameters of how to measure and indicators of what kind of emissions would qualify as green or would not, right? So do you think that an Indian taxonomy should have that level of granularity?
No, definitely it has to have some granular aspect to it, and maybe most importantly, it should converge with the other international taxonomy existing, simply because the investors are also coming from abroad. And if we want in India to attract foreign investors, they should feel comfortable with the national taxonomy. I'm not saying it should be the same as Europe or any other country. Of course, it has to be adapted to the reality in India, but it has to have some correspondence. But just 1 second on taxonomy is not going to be all. It's a must. It has to be done. It has to be here, and the government is making nice progress on having a taxonomy in India. But more than that, I think the government should also plan this transition. We need to align. We need to have on the same path supply and demand of financing. If supply is becoming the bottleneck, there going to be a shortfall for a long period of time. And unlocking the potential for supply of climate finance will require some strategic thinking and some planning. And really, we are pushing the government to, in addition to the taxonomy, come with a sustainable finance plan for the next 10 years. We have these transition plans for transport, for energy, for many other sectors, but we don't have anything in the financial sector. So we don't know what is the direction of travel, and we don't know how the government is going to, indicate to the financial sector the direction of travel. So this is something that should be done.
So in the absence of this national legislation or taxonomy, how do private credit funds select the projects that they are going to fund? How do you, what is this, what selection criteria do you use to select a green project or a company that you will fund for its decarbonization project? Maybe Shaurya, you can start, and I'd like Karthik to comment as well.
That's something we struggled with a lot, right? And I must say, as an industry, even private credit itself, just today morning I was having a conversation with somebody and he was asking me to define private credit, and I couldn't, right? So what is the difference between private credit, structured credit, performing credit, right? But having said that, we struggled with this when we were formulating our responsible investing policy, because we didn't know what is it that we can put down and what is it that we can communicate and explain to our LP base as well as to the ecosystem that, what are we doing? So we then invested in, and we got a consultant. We had PwC come and help us. Actually then define, a policy for us, which had all of these elements. We have a customized framework of 100 points where we score our investee companies at entry. And then we work on a corrective plan for an exit score, but that's then a a bespoke thing developed for us basis things we thought we could handle. But we struggled because there was nothing off the shelf we could pick up and say, okay, we will follow this framework. I mean, there were elements of, for example, IFC's framework, et cetera, were there, but everything was borrowed from there, right? But there was not something that, we could say, okay, let's pick this is easy, and then move on and implement it. So we actually spent about a year and a half getting this right. And which is why, like I told you, we realized that we may have, estimated the market, and we revised it. We added more elements to our scoring framework. But I think the short answer then is that we had to develop something from scratch, which is obviously not the optimal way for an industry to function.
And Karthik, unlike equity where, you can take controlling positions and actually engage with the company a little more, so as debt providers, right, how would you, again, measure the impact if that's something on your criteria?
Okay, time's up, so I'll be a little precise. So bottom line is, I feel, so we have, speaking for Sundaram, we have our own climate transition and ESG policy, which as Shaurya has done over the last year and a half. We've gotten it vetted by a lot of experts. We've borrowed systems, processes that are put forth by the IFC and so on. So for example, all of our real estate projects are now EDGE certified, which we find is a very effective tool. So we've, in a way, written our own little microcosm of taxonomy, really rules that we follow. And I find that regardless of strategy, whether we're looking at A sector, B sector, there are always ways that an impact can be created, right? So real estate, we have what I just said, and non-real estate, we already measure in terms of, again, emissions. We're very emissions focused on what is it that they are doing, and if part of our investment can actually go and improve that, reduce that, and so on. So I think as of the moment, till we actually get a formal set of rules and taxonomy, I think private credit industry as a whole can actually set, its own sort of little rules, but, perhaps, a subject matter for the IVCA next to look at combining and harmonizing taxonomy for private credit as a space is worth considering.
Do we have time for questions or any feedback from the audience? No time. So I'm getting indications that there is no time, but thank you so much to the entire panel for your wonderful contributions. It's been a pleasure moderating this panel. Thank you to the audience for being such a wonderful audience.
Thank you to all the panelists and to you, Mr. Upasana, for bringing the best out of this panel. Can we get together for a group photograph, please? Thank you to all the panelists for making us understand the critical importance of green credit and the innovative strategies that are required to bridge the funding gap. Thank you. And now I request Mr. Bharat Anand, partner Khetan & Company, to please join us on stage to felicitate our panelists. Can we have the felicitations on stage, please?